Looking at FX and crude oil correlations across different volatility environments, hopefully topical background here because crude oil volatility has picked up so much over the past 12 days on the onset of what hopefully is only the 12-day war, as being called right now. And U.S. dollar, surprising to me, the price action that it hasn't gotten the typical safe haven demand that it historically commands in times of geopolitical tensions. And the last wrinkle to the background here, that the U.S. is much less reliant on the Middle East and other regions for oil production, and so has shaped up to be a very interesting mix for price action in crude oil and the U.S. dollar. Is there any more background here that comes to mind for you?
My interest, I was looking at the United States rig count, and that seems to be decreasing for months over months, which is pretty interesting. But then you look at the United States oil output itself, and we're drill baby drill right now. So those two factors maybe play a little bit more into the outcome of the price of oil, right? Because the United States is a huge exporter of oil. So maybe the United States has more room to work with, right? Because in the past, when things happen like this, and there was embargoes and blocks on channels and straits, does that affect the price of oil just as much as it did historically, is the question I have. Or have times changed and commodities are largely priced on supply and demand, right? So is that supply not really a worry anymore? Plus, weak demand because of global shipping right now also is a positive sign to stress supply chains. So is that like the biggest worry to me, or was that the reason for the huge downside move also in oil we saw yesterday, right? Still trying to piece things together and see how they play out. But that was kind of a question I had there.
For sure. And so what we did, we looked over a 3-year time horizon, so 2022 to present, so not factoring in all of those crazy COVID times. We analyzed USO, crude oil ETF, and 6 major US dollar pairs, and we used that ETF to get the implied volatility, and we segmented that into quartiles by dates. So that's how we determined a low volatility over this 3-year time horizon, as well as high volatility environments. And what we have for you is our correlation matrices that include not only each FX pairs to crude oil, but as well as to each other, which it turns out gives us a little more interesting conclusions than the crude oil story itself. And while we're on it, the oil volatility that we've seen now can be served as a widespread market volatility gauge in times like this, as well as some other occasions where there are elevated inflation environments, when there's speculation around monetary policy as it pertains to inflation and across the commodity space. So first, what we got is, again, across all volatility environments, we see, looking at that top row from left to right, we'll see the crude oil correlation against the Australian dollar, euro dollar, pound dollar, dollar Canadian dollar, dollar Swiss franc, and dollar yen. And what you're seeing most correlated would be 1 or -1. Uncorrelated, moving completely independently, would be 0.0. And so nothing here from a crude oil standpoint really stands out to me. Pretty uncorrelated to these major dollar pairs. And looking across the rest of the matrix, we have, in my mind, what would be expected FX correlations to each other. We have European currencies of euro and pound moving very similarly in tandem against the US dollar. We have historical commodity correlation, or commodity currencies moving in opposite, or
I'd
moving
say
together.
same direction.
Yeah, same direction in the dollar, CAD, and Australian dollar. And anything else stand out to you here?
No, that was pretty interesting. Kind of what's interesting me on this slide itself is the correlation between Aussie and CAD. I didn't realize they had that big of a correlation, but pretty interesting as commodity currencies. That makes a lot of sense. Same with Euro Pound, and yeah, I would say that makes the most sense. I know when you look at USD CAD, that's, even though there's not really a correlation, that's the most correlated in that, from what I see in the all environments, which is as expected. Same with USD Chef. Pretty much no correlation there, which I expected there too.
Yeah, and perhaps the biggest takeaway is the most uncorrelated move in the currency space would be that dollar-yen piece to crude oil. But segmenting, in particular, high volatility environments, we see a little bit more of an interesting story shake out. We have elevated correlations across the board between crude oil and U.S. dollar pairs. Again, that U.S. dollar, Canadian dollar, the outperformer, but still a pretty modest correlation at negative 0.34. Nothing else really there, but my main takeaway here is that you do see elevated correlations across the FX space to each other. So what that tells me is when crude oil volatility is at its most extreme, it turns into, in the currency space, a lot more of a US dollar story than any of these independent regions or countries on their own against the US dollar. So in times of high volatility, US dollar moving unanimously across the board one way or the other. Then in low volatility environments, the bottom 25% of oil volatility days, we see very low correlations across the board, more than in the normal environment, to crude oil and even against FX pairs, among FX pairs themselves. So we see a slight uptick in the correlation among European currencies, so that euro dollar and pound dollar, slightly higher. Those commodity correlations sticking in as well. But what this calls out to me is that perhaps in times of low volatility, it's less of a dollar story, and other currencies are free to move on their specific or independent economic factors and less reliant on a volatility story. So nothing really surprising from any of this. I mean, the main takeaways to me are, in the long run, no real correlation among individual dollar pairs to crude oil. If you're looking for a historic outperformer, U.S. dollar, Canadian dollar, perhaps is the most correlated, but as we know, past performance certainly not indicative of future results. But in high volatility environments, you do see those correlations starting to elevate against crude oil and against the U.S. dollar itself. So that dollar storyline playing through. And low volatility environments gives you the most dynamic environment for all of these individual currency pairs and crude oil to move independently, less reliant on the U.S. dollar. Any other conclusions?
No, that would make sense, right? Because when you're looking at high volatility environments, that's really when you have a bunch of main factors at play in the market, right? And then low volatility environments is where a bunch of sub factors kind of start to take more importance. So not really a surprise at anything here, but it's cool to see data showing exactly what you're talking about there and seeing it play out in real time.